Welcome to the War Hunt Quarterly Market Update for the end of the financial year to 30 June 2025. Steve, so tell me, are we going to talk about Trump today?
I don't know what else to talk about.
Goodness me. Well, let's see if we can get through today without a reference to Donald Trump. Steve, so tell us what's been going on in Australia over the last quarter.
Yeah, sure. And look, if you look at the chart here, this is the day-by-day performance of the ASX 200 over the course of 12 months. And you can see that enormous dip happening at the start of this quarter. This happened around the world. Markets were down by 10%. That's because when tariffs were announced, I can't remember who announced the tariffs.
I can't either.
Tariffs got announced on April the 2nd and markets tanked. But a week later, the tariffs were put on hold, and then markets in Australia and around the world took off, and to be honest, they haven't looked back. You look at the performance there in Australia, we're up by 9.5% for a quarter. That's a huge quarter.
That's a big quarter.
And 13.8% for the year, for the financial year. That's much larger than the average return that you get over financial years. So all in all, it's been a great quarter for the Australian market, despite that little blip at the start.
So tell us, it's a concentrated market. We always talk about this. What have been those key drivers throughout the period?
It is a concentrated market, and I'm sure the viewers will know of the biggest stock in the Australian market is CBA. Yeah. That has been on a tear. It's up 50% for the year. Nobody knows why.
We don't understand, do we?
We just don't understand. And if you look at the chart here, I'm showing the two biggest sectors that make up the ASX 200. That's financials, which of course is where CBA lies. And then on the other hand, we've got resources, which is our BHP and Rio, and that's not going so well. And so BHP, our second largest company, is down by 10%. Over the year. Now that we do understand. The mining stocks in Australia, their share price is tied to the iron ore price. And the iron ore price has been quite low for a while because the biggest consumer of Australia's iron ore is the Chinese property market. The Chinese property market's been in a hole for quite some time, not showing any real sign of crawling out of that hole. So resource prices are a little bit depressed in Australia at the moment.
So moving on from down under, tell us a little bit about the rest of the world right now.
Yeah, so in the rest of the world, much more diversified, lots of different sectors. Look at the chart here. On the left-hand side, we're showing the developed market index. It's up 19.5% for the year. That is an incredible return. And in the past, and we've talked that, the US, which is 70% of that developed market index, has been the driver. But this year, it's actually quite even. You look at the other big markets there, Euro. Who would have thought with what's going on in Ukraine and Russia? But the Euro is the top performing market in Aussie dollars. And Japan has done well. And even the emerging markets on the right-hand side there, they're up 17.5%. For the year. They've been a laggard for a few years, so they're now right on the heels of the developed markets. All in all, for anyone in a diversified portfolio of Australian and international shares, it's been a sensational financial year.
Great year. And you managed to get through all that, the rest of the world, without referring to Donald Trump. So thank you, Steve. I'm sure the viewers will be really, really pleased about that. Yeah. So tell us about interest rates, Steve. Everyone asks about this. We've had the RBA come out this week. I note much to Dr. Chalmers' disgust that there wasn't a rate cut. But tell us about interest rates here in Australia, in particular, where it's more a lived experience. How's that impacting things?
Yeah, well, I think it's not only Jim Chalmers that was shocked by the fact that the RBA did not cut rates. It wrong-footed every economist out there. But here's the thing, and both here in Australia and in the US, the Federal Reserve, central banks are sort of got conflicting issues going on. They're slightly different in the US to in Australia. That also means that bond yields are sort of fluctuating. They're not moving around a great deal. So you can see over the course of the year, they have come down, and that's because inflation has been gradually coming down as well. Now, when bond yields go down, bond prices go up. And you can see in the chart there, we've got the quarter by quarter returns of the global bond index. So when the yields shot up, man, that's when prices went down in the second period there. But in this last period, we've got a positive return, and overall, global bonds have returned 5.8% for the year. Australian bonds, even better, again, slightly different influences working there. They're up 6.5% for the year, doing much better than 30-day term deposits, which are returning about 4.5%. So all in all, you've had this positive year in bonds, strongly positive year in equities.
So as we always say, we talk about diversified portfolios, Steve, and here at Warr Hunt, we make sure that our clients are invested with great diversification across all asset classes, and certainly within the equity space across economies and sectors, to ensure that we get the ups and downs and ride the bumps but also ride the waves along the way. Is there anything else that we should consider in amongst that, Steve?
No, in fact, I would say that the best strategy is the one that we employ, is ignore all the news going on there about trade wars and geopolitics. Stay disciplined in a portfolio. Don't change it, because that's the way that you earn these superior returns and reach your goals.
Well, thanks again, Steve, for joining us today. And thank you for joining us on our quarterly market update to the end of 30 June 2025. Please reach out if you have any questions.